Have you ever wondered how the uncertainty in commercial real estate impacts multifamily investments? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. In a recent keynote at the Vancouver Real Estate Forum, CBRE Chairman Paul Morisuti shared his insights on the Canadian commercial real estate landscape. According to Morisuti, 2025 was anticipated to be the year that economic conditions would stabilize, allowing the commercial property market, including multifamily assets, to recover and perhaps even flourish. However, the reality has been quite different, with developers and property owners continuing to face challenges due to decreased immigration, stricter borrowing conditions, and ongoing disruptions in office usage. Morisuti pointed out that the uncertainty, exacerbated by U.S. President Donald Trump's trade policies, has cast a shadow over investor and occupier sentiment. He mentioned that the volatility and confusion in trade policy have made it difficult for investors to predict and plan for the future. However, there is a silver lining. Benjamin Tal, Managing Director and Deputy Chief Economist at CIBC Capital Markets, believes that this uncertainty cannot last forever. Tal highlighted that factors such as the U.S. stock market's vulnerability, oil consumption, and inflationary pressures could lead to a renegotiation of trade agreements, potentially easing some of the current tensions. Morisuti also provided a detailed assessment of various asset classes, including multifamily, industrial, and office sectors. He noted that while liquidity remains a challenge in the office market, with selective financing and rising operational costs, there are signs of recovery. In Toronto and Vancouver, for example, the completion of new supply and a decrease in vacancy rates in high-quality office spaces indicate a positive trend. This could also impact multifamily investments as these cities remain attractive for tenants seeking proximity to employment hubs. Turning to the industrial sector, Morisuti mentioned that despite a recent pullback in demand from third-party logistics companies and a rise in construction, the fundamentals remain strong. Canadian rents have more than doubled over the past 5 years, and the major industrial markets are some of the tightest in North America. This resilience is promising for investors looking at multifamily properties, as industrial growth often correlates with increased housing demand in surrounding areas. Finally, Morisuti acknowledged the ongoing challenges in the residential condo market, particularly in Toronto and Vancouver, where unsold inventory remains high. However, he suggested that reduced construction activity and a return to normal immigration levels could lead to a resurgence in demand. This potential for a future condo boom offers an optimistic outlook for multifamily investors, as it may drive up rental demand and property values in these key markets. Let's dive into a recent development in the commercial real estate landscape that could have significant implications for the industrial sector. Montreal-based developer Rosefellow has made headlines with their acquisition of a 1.2 million square foot portion of the mega center Notre Dame in Laval for $75 million. Their ambitious plan involves redeveloping this space into a state-of-the-art, highly sustainable distribution and light industrial complex with a total investment of approximately $200 million. According to Mike Jaeger, co-chief executive officer of Rosefellow, the redevelopment will see the construction of 3 buildings totaling 550,000 square feet. The demolition of the existing retail center is set to begin as soon as existing leases end, with tenants being relocated by the end of the year. This move is part of Rosefellow's strategy to capitalize on the high demand for industrial space in the area, which Jaeger describes as highly in demand. The site is strategically located along the Highway 13 corridor in the Greater Montreal area, offering exceptional visibility and access to the regional transportation network. This prime location, already zoned for distribution and logistics, is expected to attract significant interest from potential tenants. Jaeger is optimistic about the site's leasing potential, noting that they plan to build on spec and anticipate having the entire facility leased by the time construction is complete. Despite rising overall industrial vacancy rates, Jaeger remains confident in the project's success, pointing out that while the overall vacancy rate is around 5 to 5.5%, Class A industrial space, with over 40-foot clear height, is at an incredibly low 0.2%. This makes the planned development particularly attractive for businesses seeking top-tier industrial facilities. In addition to the strategic location and high demand for industrial space, Jaeger highlighted the benefits of the surrounding amenities. The proximity to existing retail and service businesses, such as gyms, grocery stores, restaurants, and bars, aligns with a strategy often seen in the office sector, where nearby amenities are crucial for attracting tenants. This approach could enhance the appeal of the new industrial development to potential tenants. Rosefellow is also committed to incorporating sustainability and energy-saving features into the new buildings, targeting at least LEED Silver certification and aiming for net zero energy usage. This commitment to sustainability is not only environmentally responsible, but also adds value for tenants who prioritize eco-friendly practices. Mike Jaeger and his co-chief executive officer, Sam Tsumas, have expressed excitement about the strategic acquisition and its potential to contribute positively to Laval's economic vitality. With plans for about $450 million in investments in the area in the coming months, Rosefellow is positioning itself as a major player in the region's industrial real estate market. Let's take a closer look at the fourth quarter 2024 United States commercial real estate investment trends by property sector, as reported by Altus Group. This comprehensive analysis provides insights into transaction volumes, pricing metrics, and performance across various sectors, including multifamily, office, retail, and industrial. According to the report, 10 of the 15 subsectors experienced quarter-over-quarter price growth on a per square foot basis. Leading the charge were big box retail with a 9.5% increase, bars and restaurants with a 6.3% rise, and automotive properties with a 5.2% growth. Meanwhile, general industrial saw a 2.9% increase. Hospitality, industrial, and retail sectors all recorded positive year-over-year increases in average price per square foot. However, there were declines in average prices for commercial general and mixed-use properties, multifamily, and office sectors. Despite these declines, 9 of the 15 subsectors still saw positive average price growth per square foot year-over-year in the fourth quarter of 2024. The average number of properties transacted each day during the fourth quarter of 2024 hovered just above the pandemic-era lows for all property types. However, there was a quarter-over-quarter uptick for all sectors except hospitality. Year-over-year, the median square footage of individual transacted properties increased for industrial by 7.7% and multifamily by 6.1%. Conversely, hospitality, commercial general and mixed use, retail and office sectors saw declines in median square footage. The median value of single property transactions rose year-over-year across all sectors, with office leading the way at 19.8%, followed by industrial at 17.1%, and multifamily at 16.4%. Notably, over 1 in 5 industrial properties, or 20.7%, transacted during the fourth quarter of 2024 were part of multi-property sales, marking the highest proportion among property types. Interestingly, the share of hospitality properties sold as part of multi-property sales fell by 21 percentage points quarter-over-quarter to 12%, although it was up 2.4 percentage points year-over-year. This dynamic highlights the shifting landscape within the hospitality sector. The report, sourced from the Altus Group's Q4 2024 U.S. Commercial Real Estate Investment and Transaction Quarterly Report, provides valuable insights into transaction activity and pricing metrics across individual property sectors. These metrics are adjusted for typical data infill following the end of the reporting quarter, ensuring a more accurate representation of activity and capturing a comprehensive view of transaction trends and sector-specific performance. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.